A lot of pre-revenue companies are spending a lot on engineering costs along with a 7.65% payroll tax. We have helped pre-revenue startups capture 50 to 197K in credits to help offset payroll taxes without giving up equity. We'll cover how this offset works, what qualifies, how to document this correctly, and ultimately we'll provide a framework so that you can apply to you and your company to see if this can extend your runway. So we worked with an engineering company and they thought they couldn't take the credit because they didn't qualify and they thought they could only utilize it to offset taxes. Now, once we talked through the situation with them, we identified they were still in the startup phase and that they were able to utilize the credit to offset their payroll taxes. Ultimately, they had about 8 engineers on their team and close to about $2 million in total salary. Now, for the qualified wages, they had about 1.5 million. After we did the calculation, it was determined that they had about $150,000 they were able to utilize to offset payroll taxes. So how does the payroll tax credit exist and how do the mechanics work? So really the R&D tax credit, which has been around since the 80s, had a massive gap. And the IRS identified this initially around the mid-2010s. And they noticed that a lot of the companies that are doing really innovative R&D type activities were not actually getting the benefit right away. Sure, they could claim the R&D tax credit, but it's something that they couldn't claim until much later because they were still pre-revenue, pre-profit. So what they did is they decided that they wanted to enact and help these companies specifically by telling them you can utilize the R&D tax credit to offset $250,000 in payroll taxes each year. This was such a popular program that they actually boosted this by another $250,000 in the early 2020s, which allowed a company to take up to $500,000 of their R&D tax credit and utilize that to offset payroll. How does the payroll tax credit offset actually work? If you qualify for the payroll offset, you must be a startup in that initial 5-year phase. How do you claim the payroll offset and how do you know if you qualify? Initially, you have to look at 3 different rules. In general, you have to be in that 0 to 5 phase. So really what that means is that you must be in that startup phase in order to qualify. The second is that you must have under $5 million of gross receipts. Now, gross receipts is just a fancy word for sales. The government wants to see that you are still a newer, kind of smaller company and that you aren't a medium-sized company with at least $5 million in sales for that year. And finally, you can only take this payroll tax offset for 5 years in total. So when it comes down to it, it's really a 5-5-5 rule. First 5 years, $5 million of gross receipts and under, and then you can only claim it for 5 years. Once you do that, then you ultimately claim the R&D tax credit on the form 6765. And then what happens after is extremely crucial. On the form itself, you must make the election to utilize the payroll offset. And what that does is that you raise your hand to the IRS saying that you're going to utilize the portion or all of the credit to offset your payroll tax. After that, you must work closely with your CPA and payroll tax provider to file the form 8974. Now, this form is essentially the bridge between the 6765, the R&D tax credit, and your payroll offset. This will allow the payroll provider to utilize it to offset your payroll taxes and claim that payroll offset on the quarterly filed forms. So really, that's the whole process. You claim the R&D credit on the 6765, you work with your CPA and payroll provider to fill out the form 8974, and that's how you can get the benefit. We helped a pre-revenue, pre-profitable startup capture similar credits of $100,000 to offset their payroll taxes. If you want to see what the specific math would look like for you and your team, there's a link in the description to the R&D credit snapshot. I will record a short personalized video walking you through your numbers and your specific situation. If you're ready to talk, you can also book a call directly through the same link in the page. But for now, let's keep going. The question is that oftentimes, if there's no tax liability, your CPA might identify that you don't qualify for the tax credit because you have no tax liability. We get this question often because the tax credit really means a dollar for dollar offset of your taxes. Now, If you don't have any taxes, how can you claim the credit? And this is one of the misconceptions that we run into often, and one that we really want to correct. During the startup phase, the founders can take advantage of the credit by utilizing it to offset their payroll tax. Even if they can't use it to offset the payroll taxes, the credit is an extremely valuable tax attribute. It is a credit that can be carried forward, basically means that it stacks on top of each other every single year for up to 20 years at the federal level. Some states even allow you to carry forward the credit indefinitely. So in order to qualify for the R&D tax credit, really you need to look at the product that you're building and put it through the lens of the IRS's 4-part test. They need to understand why you're building the product. Are you creating something new? Are you enhancing something that's existing? But it can't just be for any reason, or it can't be simple update. Really, they want to see that you're improving the quality, reliability, or the capability of the product or process that you're trying to achieve. And then after that, it needs to be based on a hard science. So if you're in engineering or computer science, those are the things that qualify. If you're doing a process related to marketing or say art, those are the types of projects that wouldn't qualify. Then you need to look at the elimination of uncertainty and process of experimentation tests. They want to see what type of challenges did you and the team really have, and what was the process of experimentation that it took to overcome those challenges. Those are the criteria for what qualifies, and you really need to look at each product you're developing and put it through this rigorous test in order for the IRS to qualify it. A specific example we can use is a technology company building a platform. Now, we don't want to look at the platform itself as a whole as a product. We want to look at its subcomponents itself and put that through each of the tests. Ultimately, what we want to understand is that during that year, what was the focus of the R&D team and what components were they actually developing? Maybe they were building out one specific functionality on the platform. So you really want to take that one functionality and put that through the 4-part test. What were the new capabilities? What were the technical challenges? How did you experiment to overcome those challenges and see if that particular component would qualify? From there, you would look at the different resources that put their time and effort into this specific component, and that's how you would map the activities to the project and ultimately the credit. So one area we want to talk about in detail is documentation. And this is a big area of focus for the IRS. Now, you probably heard in the last couple of years of some changes going on with the research and development tax credit. Essentially, what the IRS is moving towards is they want more data up front. They want companies to provide additional documentation on the forms when the credit is filed. So as an example, we recently worked with an engineering company that had done an R&D credit study through an automated AI platform. Now, this is great for really early startups that just want to start claiming the credit right away, but there are some limitations when it comes to these platforms. Oftentimes, they don't hold up to rigorous audit scrutiny and do not provide the level of documentation that's needed by the IRS. Really, what the government wants to see is a clear nexus from the credit that's being claimed to the project, to the activities, down to the actual individual level. Ultimately, that's where these solutions don't hold up. They're able to provide a credit number on a form, but they're not able to back it up once it comes under scrutiny. And once the new changes to the 6765 form become mandatory in tax year 2026, you'll need to have all this documentation ready in order for it to hold up under scrutiny. So going back to the example with the engineering company, we were able to look at their documentation, build up a support package, and ultimately redo the study for them. It was able to hold up under audit scrutiny and investor due diligence. And ultimately, this is what the IRS is moving towards anyway. So it's better to have a system in place already so that you're ready for when this becomes mandatory in tax year 2026. So now you're probably thinking that this is going to be a ton of work. There's so much documentation that we need in order to substantiate the credits that are being claimed. And you're right, there is a lot of work that needs to go into it. But the good news is that you already have most of these artifacts already. Engineering teams, software companies, all of these different companies typically have a repository that has artifacts of the development process that are in place. Think of Jira, Confluence, GitHub. These are just a few repositories that most engineering teams already utilize to record their development activities as they're being worked on. Now, What's great about this is that you can create a clear connection of the work being claimed to the R&D tax credit utilizing these documents already. That's not additional work. That's work you're already doing. All you have to do is ensure that you're tagging some of the projects and keeping a clean record of what projects were worked on during the credit year. I even had a mentor of mine who had a client, and this client would just have a folder called tax shit, and he would throw stuff in that folder every single quarter. Whatever process you use, you can go ahead and utilize it, but ultimately know that whatever you have should be part of your system and should be built predictably so that every single year you have this documentation ready to provide to the government in case needed. A lot of pre-revenue companies are carrying heavy engineering costs with payroll taxes, and with zero revenue coming in, that's really no revenue to offset the burn. Most founders never hear about the payroll tax offset because their CPAs don't specialize in this specific area of tax, or oftentimes they don't understand the documentation requirements and the documentation standards get completely missed. With the right specialists, this becomes structured and predictable. Our clients have captured $50,000 to $195,000 of payroll tax offsets depending on the size and the qualifying team that was worked on. With the right specialists, this becomes structured and predictable. So we have helped companies capture $50,000 to $197,000 in payroll offset, depending on the engineering size and the qualifying items. Now, the reason why most of this gets missed is because their CPA oftentimes doesn't specialize in this specific area. Look, we understand it's very, very niche, and that's nobody's fault. If you want to see what this looks like for your specific company, there is a description below that you can click on for your own personalized R&D credit snapshot. I will record a personalized video walking you through your specific area of documentation, what the gaps are, and to see if there are any areas that need to be addressed. Now, if you want a deeper discussion, there's also a link in the description below where you can book a call directly, and we can get on a call and chat right away. So thanks for watching. See you in the next one.